Well, I pulled up a chart from the Federal Reserve here, the federal funds effective rate, and it shows what happened back here in 2008, right? Because the wheels fell off the wagon, so they opened the floodgates and lowered rates down again. And we stayed there until 2016, started coming back up. 2018, they realized that was a mistake. So they thought, and then the pandemic hit. And like you said, they make short term moves. And here we went, boom, down to about 0.5
Mm-hmm.
or 0.05. And then now it shows where we're at today, going up, up, and up. What's interesting is you look at today's rate right here and you look at the rate 2008, but back here, nobody was paying that. Those were all adjustable rate mortgages and teaser loans. So we may have been, so here's a Fed's fund rate at almost 5.25. So the prevailing rate was 6.9 to 7. But no, everybody had a 1% loan or is interest only loan.
Well, that's a great point you make. I don't know if I would say everybody had those type of loans. They did exist. And
there were enough of them to cause a problem.
yeah, and I honestly took a significant hit in my income in 2007 because I would not do some of those loans. I turned down, I'd say over it's crazy to do as a salesperson and a loan officer, but I personally declined to do. I told the people they could get the loan. I was not willing to put my name on it. Those loans that were just super crazy, where you were the negative AM loans made no sense. You were letting people borrow money at 1 or 2%, but the loan was accruing interest at 7% on the back end. Well, that only takes 2-3 years, and your loan balance is 20 to 30% more than what you owe today. So you're actually right. You hit the nail on the head there. I would say in 06 and 07, 30-40% of the loans I was doing were 2, 3, or 5 year ARMs. And you could buy people down even then into the 5s. So you're correct. There was very few people taking on a 7, 7.5, 8% interest rate. Basically, only the people with low credit, difficulty. That's just the only product they could get. So yeah, we're actually being pinched harder today, I would say, because you can't get a 4 or 5, percent 2-3 year ARM right now.
No, and the bond market was kind of pushing back on the central bank for quite a while, weren't they? They were just like, yeah, he says he's going to raise rates for longer and higher and for longer, but they just were kind of pushing back. Now I view it as Chairman Powell just kind of sitting back going, nope, told you.
Yeah, so many people didn't buy it, even though he was, coming out weekly saying, we're going to do it. We're going to raise, I don't remember what his initial estimate was, but I think they said they were going to get to 3%, in 6 months to a year. And everybody was like, oh, BS, he's never going to get there. Well, here we are at what, 5.25. And so that's a great point. And I don't see them reversing course like they did in 2008, because there was already cracks in the employment picture in 2007. I remember it. People were starting to get laid off. So when the 2008 thing happened and they cut interest rates and the stock market collapsed, there was already a year to year and a half of pain in the actual economy, right? And we don't have that right now. We're under 4% unemployment.